Hey everyone, welcome back to the channel. Today, we're going to break down 15 powerful assets that are making the rich even richer, and how you can start building wealth with them too. The wealthy don't rely on just one asset. They diversify, and each asset works in different ways to generate income and long-term financial growth. Let's dive right in. While cash might seem basic, it's an essential asset for wealth building. It's the backbone of financial flexibility, allowing the wealthy to quickly seize opportunities or weather financial downturns without selling other investments at a loss. What is cash as an asset? Cash refers to liquid funds that are easily accessible, such as in savings or checking accounts, and can include cash reserves held in high-yield savings or money market accounts. Why the rich hold cash? Liquidity for opportunities. Having a substantial cash reserve allows the wealthy to act fast on investment opportunities like buying discounted real estate or stocks during market downturns. The ability to deploy cash immediately can mean huge returns. Financial security. Cash provides stability. During times of financial crisis or economic uncertainty, holding liquid cash allows the rich to avoid selling assets at a loss. It ensures they can cover expenses without needing to touch their long-term investments. How to build and manage cash wisely. Build cash reserves. Aim to keep 3 to 6 months' worth of living expenses in liquid savings to handle emergencies. Use high-yield savings accounts. These accounts offer higher interest rates than standard savings accounts, allowing your cash to grow, albeit slowly. While cash won't grow as fast as other investments, it's essential for creating a buffer and seizing opportunities when they arise. Real estate is one of the most popular wealth-building assets. It provides both rental income and appreciation over time. Wealthy individuals often hold a diverse portfolio of properties, including residential, commercial, and land. What is real estate as an asset? Real estate refers to properties such as homes, apartment buildings, office spaces, and undeveloped land. Investors can earn money through rental income, property flipping, or holding property to benefit from appreciation. Why real estate builds wealth? 1. Rental income. Owning property provides a steady stream of rental income. This income is often considered passive, meaning that after the property is set up and tenants are in place, minimal effort is needed to maintain it. 2. Appreciation. Real estate typically appreciates in value over time, especially in high-demand areas. Even during periods of market volatility, property values tend to rise over the long term, providing substantial returns when sold. 3. Leverage. Real estate allows for leverage, meaning you can borrow money via a mortgage to acquire a property and benefit from the full value of that asset while only putting a fraction of your own money into it. How to start in real estate? 1. REITs, real estate investment trusts. If buying a property outright seems too costly, invest in REITs. These funds pool money to invest in real estate, offering exposure without the need to manage physical properties. 2. House hacking. For beginners, consider buying a multi-family home, living in one unit, and renting out the others. The rent can cover your mortgage, building equity while you live there. 3. Research markets. Look for up-and-coming areas with increasing demand. You can buy properties at lower prices and benefit from future appreciation. Real estate remains a tried-and-true wealth builder due to its ability to generate both short-term cash flow and long-term appreciation. Stocks are one of the most accessible and profitable ways to build wealth. By owning shares in a company, you're entitled to a portion of its profits, either through dividends or capital gains. What are stocks? A stock represents ownership in a company. When you buy stocks, you're buying a portion of that business, and as the company grows, your investment increases in value. Stocks are traded on public markets, making them highly liquid. Why do stocks build wealth? 1. Dividends. Some companies share their profits with shareholders by paying dividends. This provides an ongoing income stream, even if you don't sell your stocks. Over time, reinvesting dividends can compound your returns. 2. Capital appreciation. As companies grow and increase in profitability, their stock prices rise. Investors who bought stocks early can sell them at a significantly higher price. For instance, those who invested in Apple or Amazon 20 years ago have seen astronomical returns. 3. Compound growth. By reinvesting dividends and holding stocks long-term, your gains compound, meaning you're earning returns on your previous returns. How to start investing in stocks. Index funds and ETFs. For beginners, investing in broad-based index funds like the S&P 500 or ETFs provides diversification and reduces the risk associated with picking individual stocks. Long-term focus. The stock market can be volatile in the short term, but over time, it tends to grow. A long-term investment approach helps you ride out short-term downturns. Dollar cost averaging, invest a fixed amount regularly, say monthly, to smooth out the price fluctuations and lower the risk of buying at high points. Stocks remain one of the best long-term assets for building wealth, especially when you take advantage of compounding and diversification. Bonds provide a low-risk, steady income and are ideal for those seeking stability in their investment portfolios. Unlike stocks, bonds offer predictable returns through interest payments. What are bonds? Bonds are essentially loans made to governments or corporations. In exchange for your investment, the bond issuer promises to pay back the loan with regular interest over a set period and return the principal once the bond matures. Why bonds are valuable? Reliable income. Bonds provide a fixed, predictable income through interest payments, making them a safer option for conservative investors or those nearing retirement. Lower risk. Compared to stocks, bonds are less volatile. Government bonds in particular are considered one of the safest investments because they are backed by the full faith and credit of the issuing country. Types of bonds? Government bonds. These are bonds issued by national governments. For example, U.S. Treasury bonds are considered extremely safe. Corporate bonds, issued by companies. Corporate bonds usually offer higher interest rates than government bonds but come with slightly more risk. How to invest in bonds? Start with government bonds. U.S. Treasuries and similar government-issued bonds offer low risk. You can buy them directly or through bond funds. Bond ETFs. These funds allow you to invest in a diversified portfolio of bonds, giving you broad exposure without having to pick individual bonds. Consider bond duration. Short-term bonds mature within 1 to 3 years and offer lower returns but less risk. Long-term bonds, 10 or more years, provide higher interest rates but are more sensitive to interest rate changes. Intellectual property, or IP, is a lucrative asset that includes patents, trademarks, and copyrights. These assets can generate income through royalties or licensing, making them a favorite among entrepreneurs and creatives. What is intellectual property? Intellectual property refers to creations of the mind that are legally protected, such as inventions, designs, music, and brand names. Owning the rights to these assets allows you to profit from their use. Why IP generates wealth? Royalties and licensing. Once you've created and protected your IP, you can license it to others, generating royalties each time it's used. For example, Michael Buffer made over $400 million by trademarking the phrase, "Let's get ready to rumble." Monopoly rights. With a patent, you have exclusive rights to profit from your invention for a set period, allowing you to charge for its use or sell it outright. How to create and profit from IP. File a patent. If you invent a new product or process, filing for a patent protects it from being copied, allowing you to monetize it. Trademarks. Protect your brand's name, logo, or slogan with a trademark. Once protected, you can license your brand to others for a fee. Sell or license your IP. Consider licensing your patented products or selling the rights to companies, allowing them to produce and sell them while you collect royalties. In the digital age, digital content like ebooks, online courses, and YouTube videos can be incredibly lucrative. Once created, digital content can generate scalable passive income for years. What is digital content? Digital content refers to any online product that can be sold, such as instructional videos, ebooks, or courses. These assets are infinitely scalable, meaning you can sell them to an unlimited number of people without additional costs. Why digital content is a great asset? Scalability. Once you've created a course or video, you can sell it over and over again without any additional work. This scalability allows for massive growth with minimal effort. Low upfront costs. Unlike physical products, creating digital content typically requires very little upfront investment. Platforms like YouTube, Udemy, and Amazon allow you to create and sell digital content with ease. How to start with digital content. YouTube channel. Create videos on evergreen topics like cooking, fitness, or personal finance. Once you reach 1,000 subscribers and 4,000 watch hours, you can apply for the YouTube Partner Program to start earning ad revenue. Ebooks. Write and self-publish ebooks on platforms like Amazon Kindle Direct Publishing. Once published, the book can sell indefinitely without further effort. Online courses. If you have expertise in a particular field, create an online course using platforms like Udemy or Teachable. Courses on evergreen topics can generate income for years. Commodities like gold, oil, and agricultural products are tangible assets that provide a hedge against inflation and economic downturns. They're used globally and have intrinsic value. What are commodities? Commodities are raw materials that are either consumed or used in production. They include metals like gold, silver, and copper, energy sources like oil and natural gas, and agricultural goods like wheat or coffee. Why commodities build wealth? 1. Inflation, hedge. Commodities, especially gold, often increase in value during periods of inflation. When paper currencies lose value, investors turn to commodities as a safe store of value. 2. Global demand. Commodities like oil and agricultural products are always in demand, making them relatively stable investments over time. Rising global consumption can push prices higher, creating profit for investors. How to invest in commodities? 1. Commodity ETFs. These funds allow you to invest in a broad range of commodities without directly buying physical goods. They're ideal for investors who want exposure to commodities without the hassle of storage. Physical gold and silver. If you want to invest directly in commodities, you can buy physical gold or silver. However, this comes with storage and security challenges. 2. Futures contracts. For more advanced investors, commodity futures allow you to speculate on the future price of commodities. This can be highly profitable but is much riskier. Collectibles such as fine art luxury watches and vintage cars offer an alternative way to build wealth. These tangible assets can appreciate significantly over time if you invest wisely. What are collectibles? Collectibles are items that are rare or unique and can gain value over time. These include things like paintings, antiques, rare coins, and vintage cars. The value of collectibles is often tied to their scarcity and historical or cultural significance. Why collectibles can build wealth? 1. Appreciation. High-quality, rare collectibles can appreciate significantly, sometimes even outpacing traditional investments like stocks. For instance, rare Rolex watches and vintage cars have seen massive increases in value over the past decade. 2. Diversification. Collectibles provide an alternative investment that isn't correlated to stock markets or bonds, giving investors a way to diversify their portfolios. During periods of economic uncertainty, collectibles can retain or even increase in value. How to start with collectibles? 1. Invest in what you know. Focus on collectibles that interest you and that you understand. Whether it's art watches or rare cars, having knowledge in the field helps you spot undervalued items. 2. Buy from reputable sources. Use auction houses like Sotheby's or Christie's to ensure you're buying authentic and valuable collectibles. Alternatively, you can explore online marketplaces, but make sure to verify authenticity. 3. Store and protect. Proper storage is key for preserving the value of collectibles. Art coins and vintage cars require specific conditions to prevent deterioration. Equipment refers to tools that help generate income, such as machinery, laptops, or vehicles. For many professionals and business owners, equipment is essential for driving productivity and revenue. What is equipment as an asset? Equipment includes any physical items you use to generate income in your business or profession. Examples include tractors for farmers, laptops for freelancers or software developers, delivery vehicles for couriers or logistics companies. Why equipment builds wealth? Income generation. Equipment directly contributes to income. For example, a farmer relies on tractors to plant and harvest crops, while a graphic designer needs a computer and design software to create work for clients. Scalability. Investing in more equipment can expand your business. For instance, buying additional construction equipment could allow a contractor to take on larger or more projects, increasing their overall revenue. How to invest in equipment? Buy what you need. Focus on equipment that is essential to your business or profession. Make sure the equipment will directly impact your ability to generate income. Consider leasing. If the cost of buying equipment is too high, leasing is an option that provides flexibility. While you won't own the equipment, you'll avoid the large upfront cost. Maintenance is key. Regular maintenance ensures your equipment lasts longer and continues to contribute to your income without unexpected breakdowns. Owning a business is one of the most direct paths to wealth creation. Whether you start your own company or invest in existing businesses, the ability to generate profits and grow the value of a company can lead to significant financial gains. What is business ownership? Business ownership involves controlling and operating a company that provides products or services. You earn money through the business's profits, and as the company grows, its overall value increases, allowing for potential equity sales or dividends. Why is owning a business lucrative? Well, profit generation is a key factor. A successful business creates profit by selling goods or services. As the business grows, the revenue and profit increase, allowing owners to reinvest or take profits. Equity growth is another significant benefit. When you own a business, you own equity in that company. As the business becomes more valuable, so does your equity. This means you can potentially sell the business or your shares at a much higher price in the future. How can you own a business? Start your own business if you have an idea or expertise. Whether it's a service-based business or a product-focused company, building something from the ground up gives you full control over your success. Alternatively, you can buy a franchise. Franchises allow you to run a business under an established brand. This reduces the risk associated with starting a business from scratch, as the business model is already proven. Lastly, consider investing in existing companies. For those who don't want to be involved in day-to-day operations, buying equity in established businesses is a viable option. This can be done through private equity or investing in small businesses that show promise. Royalties provide passive income through the ongoing use of intellectual property. By creating something like a book, song, or invention, you can earn royalties every time it's used or sold. So, what are royalties? Royalties are payments made to the creator or owner of intellectual property for its continued use. This can apply to books, music, films, or even patents. Each time someone uses or sells your IP, you receive a percentage of the profits. Why do royalties build wealth? Well, they offer passive income. Royalties are a form of passive income because once the IP is created, it can continue generating income without ongoing effort. For instance, authors receive royalties for each book sold, and musicians get paid every time their song is played. Moreover, intellectual property can continue generating income for years or even decades after it's created. For example, musicians like Mariah Carey continue to earn substantial royalties from songs recorded decades ago. How can you earn royalties? Write a book or music. Authors and musicians can earn royalties from each sale, stream, or public performance of their work. You can also license your inventions. If you hold a patent, you can license your invention to companies that want to manufacture and sell it. They pay you a percentage of the profits in exchange for using your patent. Another way is to sell or license film rights. If you create a screenplay, book, or piece of music, you can sell or license the rights to film or production companies, earning royalties each time it's used commercially. Venture capital involves investing in early-stage startups in exchange for equity. While high risk, these investments can offer enormous rewards if the startup succeeds. What is venture capital? Venture capital is the financing provided to startups or small businesses with high growth potential. In exchange for the capital, investors receive equity in the company. If the startup grows and succeeds, that equity can become incredibly valuable. Why is venture capital lucrative? Well, it has high growth potential. Startups have the potential for explosive growth. Early investors in companies like Facebook, Uber, or Google have seen their initial investments grow exponentially, leading to significant financial gains. Equity ownership is also a major benefit. Venture capital investors own a stake in the business. As the company grows in value, so does their equity, which can be sold for a profit during an IPO or acquisition. How do you invest in startups? One way is through angel investing. If you have capital, consider angel investing, where you provide seed funding to very early-stage startups in exchange for equity. Angel investors are often the first external investors in a company. Another option is venture capital funds. For those who don't want to pick individual startups, consider investing in a venture capital fund. These funds pool money from multiple investors and spread it across a portfolio of startups, reducing risk while maintaining high upside potential. Lastly, understand the risks. Venture capital is inherently risky, and many startups fail. Be prepared for losses, but also know that the potential for enormous rewards is part of the game. Cryptocurrency like Bitcoin and Ethereum has revolutionized the financial world by offering decentralized digital currencies that aren't controlled by governments or central banks. While risky, early adopters have seen massive gains. What is cryptocurrency? Cryptocurrencies are digital or virtual currencies that use cryptography for security. Unlike traditional currencies issued by governments, cryptocurrencies are decentralized and operate on blockchain technology, which is a distributed ledger of transactions. Why cryptocurrency builds wealth? Potential for high returns. Early investors in cryptocurrencies like Bitcoin and Ethereum have seen extraordinary returns as the value of these digital currencies has skyrocketed. Bitcoin, for instance, went from being worth pennies to tens of thousands of dollars in just a decade. Decentralization cryptocurrencies operate outside the control of governments and central banks, offering a new way to store and transfer value. Blockchain technology. Beyond the currencies themselves, the blockchain technology that powers cryptocurrencies has numerous applications, from decentralized finance, DeFi, to smart contracts. How to invest in cryptocurrency? Use trusted platforms. Start by creating an account on platforms like Coinbase or Binance, where you can buy and trade cryptocurrencies. These exchanges are secure and easy to use. Diversify. While Bitcoin and Ethereum are the largest cryptocurrencies, there are thousands of other digital assets with potential. However, the crypto market is volatile, so it's essential to diversify and not put all your funds into one coin. Cold wallets. To store your cryptocurrency securely, consider using cold wallets, which are not connected to the internet and offer the highest level of security. Mutual funds and exchange-traded funds, ETFs, offer diversified investing by pooling money from many investors to buy a broad portfolio of stocks, bonds, or other assets. This allows for lower risk and broader market exposure. What are mutual funds and ETFs? Mutual funds and ETFs are investment vehicles that allow you to invest in a basket of stocks or bonds. Mutual funds are actively managed, while ETFs are passively managed and trade on the stock exchange like individual stocks. Why mutual funds and ETFs are attractive? Diversification. By holding a wide range of assets, mutual funds and ETFs spread out the risk, reducing the chances of significant losses from a single stock or bond. Lower fees. ETFs in particular tend to have low management fees, making them an affordable way to invest in a diversified portfolio. Accessibility. Both mutual funds and ETFs allow individual investors to own a piece of the broader market without needing large amounts of capital or extensive investment knowledge. How to invest? Index funds. For beginners, index funds like the S&P 500 ETF offer exposure to the top 500 companies in the US with minimal risk and low fees. Automate your investments. Many brokerage platforms allow you to set up automatic investments into mutual funds or ETFs, helping you stay consistent with your contributions. One of the most underrated assets is your education and skills. The more you learn, the more you earn. Investing in yourself, whether through formal education, online courses, or certifications, can significantly increase your earning potential. Why education and skills are valuable? 1. Higher earning potential. Studies consistently show that higher levels of education and specialized skills lead to better job opportunities and higher salaries. Whether it's obtaining a college degree or mastering a trade, education opens doors. 2. Career advancement. Continuous learning keeps you competitive in the job market. In fields like technology, finance, or healthcare, ongoing education and certifications can lead to faster promotions and more lucrative job opportunities. 3. Entrepreneurship education also equips you with the tools to start your own business, whether through knowledge, skills, or networking opportunities. For instance, learning digital marketing or coding can lead to launching a successful online business. Conclusion. Wealth grows by owning diverse assets. Start small, invest smart, and let your assets work for you. Which asset will you start with? Let us know in the comments, like this video if you found it helpful, and subscribe. If you have any video ideas you'd like us to cover, drop them in the comments. Until next time.